Welcome to Steve Savant's Money, the name of the game. Hi everyone, I'm your host, Steve Savant, syndicated financial columnist and money gamer extraordinaire. Today we're talking about how to maximize Medicare in retirement with nationally recognized retirement expert, Curtis Cloak. Well, welcome to the show, Curtis.
Thank you, Steve. Good to be here.
Curtis, I have to say, we get a lot of traffic and Google is huge on Medicare, and that's why we're having you on today. I have maybe 1,200 shows on the internet, and I don't think we did one of them on Medicare.
Wow.
Think about that. And how important is Medicare to retirement planning?
Well, according to the experts, health insurance in retirement is the second largest expense for retirees. So I would suspect that if there's anything that is second most expensive that we have to manage in retirement, we better be paying attention to it. And here's what I find. I find that a lot of financial professionals who are in the retirement income space are really good at what they do with defining the products and the services and the building of the asset allocation models and all the forecasting that they have to do. But I find that very few of them have any knowledge or expert at all with regard to the issue of Medicare and senior health insurance issues. And unfortunately, unless they're actually partnering with somebody that brings that service to them, you need to really be focusing on retirement income shops that either have that partnership or they have an in-house expert.
You have added this on what part of your career? When did you start adding Medicare into your thinking?
Well, I started out, as a life insurance agent that got into Medicare supplements, and Medicare supplements ultimately is what got me into retirement planning. So there are really 7 things to know about Medicare. So Medicare, I'm just going to give some real general basics. Medicare Part A is your hospital coverage, and it's free when you turn 65. It's just kind of automatic. Medicare Part B is your doctors and your outpatient and your preventative medical supplies. Part C is your Medicare Advantage plans, and it's not real new, but hasn't been around a real long time. And of course, we've got this infamous, I guess I should have finished, Medicare Advantage plans, and it replaces your normal Medicare. I wanted to mention that what happens is these Medicare Advantage companies kind of step in as your Medicare, and the stipend, the value, what Medicare says is that your value, your benefit is worth every month. They actually have a dollar amount that they provide each of these Medicare Advantage carriers when you sign up for them, and it becomes your health plan, usually becomes your drug plan, and of course you don't have traditional Medicare. You're still paying your Part B premium, but that allocation that normally is considered to be a benefit to you under the Medicare program becomes a benefit to the Advantage plan. And then lastly is the Medicare Part D, which is a very limited drug coverage. So, it's not broad like we think of in a drug card program at our employer, while we were working. But Medicare Part D is our limited drug coverage plan. And so premium penalties may apply for improper delay. So a lot of folks don't know this. If you don't turn on your Medicare Part B at the right time, you don't turn on your Medicare Part D at the right time, there are penalties where you're going to pay for every month or every year delay extra premium dollars over what you would have had to pay if you're not paying attention to those. And we'll get a little bit more into those details. So that's number one. Number two, Medicare covers only partial expenses. See, a lot of folks think that we don't have to worry about Medicare or health care expenses.
So
at that time.
are they thinking really Medicaid, Medicare, and that? Or they
maybe
Medicaid,
maybe true about that, but it's still not going to cover everything. So what are the expenses we need to worry about? There's going to be deductibles under Medicare. And there's going to be copays under Medicare. And there's going to be dental that's not covered under Medicare. Vision's not covered under Medicare. Podiatry is not covered under Medicare, and major long-term care expenses are not covered by Medicare. Now, I'm not going to say that there are no long-term care type benefits that are covered under Medicare, but they're extremely limited. And since this is kind of a 101 discussion, I'm not going to drill down into those weeds. But you need to know there's a lot of things not covered by Medicare, and once deductibles and copays are paid, they only cover 80% of what they approve. So you still have a lot of additional expenses to be paying attention to. So that's the second thing. The third thing that I think you should know is this thing called HSA accounts, health savings accounts. So it's kind of two-pronged. First, you have to have a health care plan. Now we're talking about pre-65 now. We're not talking about post-65. But prior to age 65, you can have a health care plan that qualifies as a high deductible plan for which you can now have a health savings account, and that health savings account much like contributions to, say, a Roth or a traditional IRA, probably more like an IRA, allow you to maximize certain amounts, whether you're a family or whether you're single, and it's pre-tax dollars, it grows tax-free, and if you use it for medical expenses, before and after retirement, 100% tax-free, even the gains. But as soon as you turn 65, whatever you've managed to stuff into that HSA, no more contributions. And so we recommend that you fund all that you can into your HSA and consider HSA plans long before you retire so that you have this right and get as much in there before age 65 as you can. And if possible, try not to use that HSA account, even though you can, to fund those out-of-pocket dollars before you get 65, because you're getting the pre-tax dollar going in, and if you have enough medical expenses based on the 10% above your AGI, you've got a threshold that you have to get on medical expenses to have it additionally deducted. You might have 2 deductions, and so the goal here is to let that money grow tax-free inside that HSA as long as possible, because when you get to the other side, you can now fund your long-term care insurance, your Medicare coverages, and your Part D. There's a lot of medical expenses. These deductibles aren't covered. There's a lot of things that you can pay for, but you're paying for it without eating up your Roth dollars. You're paying for it with tax-free growth dollars. And so that's an advice.
To me, that's huge. When we come back from the break, we're going to continue on this 7 things you need to know about Medicare that could impact your retirement. We'll be right back. It's not how much money you make, it's how much money you keep. And keeping more of your money is even harder these days with high taxes, fund expenses, and fees for financial advice. And when you consider the uncertainty of the market and the rising cost of living, the purchasing power of your dollar is constantly at risk. But a tax-deferred annuity with an inflation rider can be the most cost-effective way to generate increasing annual income without market volatility. For more information on how annuities may work for you, just email me at steve@thenameofthegame.tv and ask for our free. Well, welcome back to our second segment. We're with Curtis Cloak. We're talking about Medicare because this is really helpful at our elementary understanding of Medicare.
So, yeah, Medicare Part B and D can be delayed. See, you and your spouse are covered. If you and your spouse are covered by an employer group plan, and traditionally it's with employees 20 and above, those employer groups are going to be primary for Medicare. And so if that's true, whether you're the employee or the spouse of the employee, you can delay turning on Part B. And understand, A is free. It's going to turn on at 65 no matter what. But B costs you right now roughly $105 a month. And that's if your income qualifies you for Tier 1. There's 4 tiers. We'll cover that here in a minute. But you can eliminate that drag on your Social Security, or if you delay Social Security, you actually have to write a check to Medicare for that $105. If you don't turn it on because you qualify, then you can save that $105 in either in your Social Security or in your bank account. It may be covered under plans with fewer than 20 employees. This is something I recently discovered. Only if the plan or the insurance carrier allows the plan to remain Medicare primary. I have recently discovered that there are plans out there, insurance companies, that have made a decision that they're going to allow Medicare to be primary across the board, no matter how many employees are affiliated with that group. You won't know if you're with a group under 20 lives unless you ask. Now, that carrier is still going to ask each employee after they turn 65, have you turned on B or have you not turned on B? Now, if you've turned on B, they're more than glad to lower their benefits to allow B to be primary. But if they allow their plan to be primary, and that's an election that they made a decision to do, you may be wasting that $105 in order to do that. So just check with your plan administrator on that. And then penalties will apply if you're not eligible for a group plan that carves out Medicare as primary. So we've had some folks that thought period of COBRA count, doesn't count. Have to have somebody being actively employed for this absolutely to be true. So be careful that you don't assume something that gets you into penalty territory. So number 5 is self-employed, and those employed by small employers must elect Part B and D. So there's no delay abilities here. We turn 65, you're turning these things on. You have 7 months in the initial period when you first are eligible for Plan A, Plan B. And so you can turn it on 3 months prior, the month of, and 3 months after. That's your 7-month window. And if you do it then, there's no penalty and there's no medical questions. They have to take you. There are some special enrollment periods. This is 101 again, so I won't get into there, and there's an 8-month window for that. And then lastly, the surcharge penalties apply from proper delay, or 10% increase for each 12-month period delay. On Medicare Part D, it's a 1% per month of delay, extra premium, penalty for the rest of your life. So you want to make sure you don't hit these penalties.
I would guess that's stiff.
That's pretty bad. Number 6, as we're counting down here, is very few people understand that whether you're single or whether you're a couple, there's a schedule, and they've tiered the cost of these premiums. This is a very remarkable thing for most people. So let's say for a minute, back it up here. Let's just say for a minute that I'm a couple making $165,000 right now. At $165,000 at a couple, we're each paying $104,490, right? But what happens? We've heard about the torpedo tax, where we go from a joint filer to now we've got one surviving spouse and a single filer. What happens at $165,000 if I die and now my wife's a single individual? Where do I go on a single to get to, I'm over 165. So suddenly my wife isn't paying $104.90, she's now paying $272.70. So understand that when I use all these bracket bumping strategies and all this tax efficiency at the front end of retirement, depending on the income level and depending on whether it's single or couple, yeah, I could substantially lower the premiums also related to the cost of Medicare.
Well, and which is one of the reasons why we're talking about this, is because this now has a secondary play. All the things we're talking about, bracket bumping, Rothing, all those things have a direct result to this.
Absolutely. So remember the torpedo tax, but remember the Medicare torpedo. It's equally as impactful. So last thing is, not all retirement income sources count toward Medicare premium when counting this tier. So high net worth clients, a lot of them, I can keep them out of the 3.8 Medicare Surcharge-Tax. I can keep them at tier 1 or tier 2 and still have a lot of income. So HSA distributions, qualified expenses do not count to my income when I look at the tier, and they don't count taxes. Roth IRA distributions don't count to the tier. 401k Roth distributions don't count to the tier. Reverse mortgage loans don't count to the tier. Non-qualified life insurance distributions with a withdrawal to basis and loan strategy doesn't count against the tier. And tax excluded FIBO portion of the non-qualified S&P income don't count against the tier. So there's a lot of things going on when I pay attention to all this tax efficiency. Non-qualified FIFO annuity, as we talked about, don't count toward that tier. So there's a lot of things that you can do if you know what it is that you're doing to really mitigate the cost of health care, and you can make a particular focus on it and create these efficiencies.
Well, that's our show for today. I want to thank Curtis Cloak for being my special guest in today's Money Mentor. And before moving forward with any of the ideas on our show, always consult your tax advisor or your legal counsel. And remember, as the good Reverend John Wesley once said, make all you can, save all you can, give all you can. I'm Steve Savant. We'll see you next week.